Hi guys, welcome back. Today we will be having application of relevant costing to keep or drop a division or product line. Keep or drop decisions. In a keep or drop decision, these are for companies with more than one division or product lines. If one of the product lines or divisions seem to operate at a loss, the company might consider discontinuing it. However, it doesn't follow that when a product line or a division is showing a loss in the income statement, discontinuing it will save the company that same amount of loss. It is possible that while all revenues from such a division or product line will stop being generated, not all costs would be avoided by halting such division or product line. To have a rational decision making, let us refer to the following template. So, in a keep or drop type of decision, there are basically two alternatives. Obviously, whether to keep or drop the product or division. If we are going to keep the product or division, nothing new will happen. In short, there will be no increase in gains, there would be no increase in profits, nor incurrence of additional losses. No changes would happen. But if we are going to drop the product line or division, the sales revenues to be generated by that product line or division will now be not generated. There will also be costs that can be avoided that's associated with that product line or division. Now, if the case is being silent about what costs are avoidable, we are going to assume that all variable costs and direct or traceable fixed costs would be avoided if we are going to drop the product line or division. Next, it will also be possible that discontinuing the product line or division will have an impact on other product lines and divisions remaining in the company. This can happen when the product being dropped is a substitute or a complement of the remaining products or divisions in the company. A substitute is a product that can be used as a replacement of another product. As such, dropping a product substitute can increase its sales. Meanwhile, a complement is a product that is used together with that other product. Dropping a product's complement can decrease its sales. So it would depend whether there is a remaining product that is a substitute or a complement of the product to be dropped. At the end, this can have an increase or decrease in the profit of the company. To demonstrate how this works, let us refer to the following sample case. U Corp offers two products to the market, S and T. The following are the segmented income statements. So we would have revenues, variable costs, the difference is a contribution margin, direct fixed costs, the difference is segment margin, common costs allocated, the difference is the operating income. Both for product S and product T, as well as the company as a whole. Note that product T is showing a loss in the income statement. But does it automatically mean that we should drop product T? It doesn't follow all the time. So let us refer to the questions. Should U Corp discontinue offering product T? In answering this question, let us refer to the following template. If we keep product T, nothing new will happen. No increase or decrease in profits. If we drop product T, naturally, all sales revenue pertaining to product T will now disappear. 150,000 pesos. As for the cost that can be avoided as a result of dropping such a product, we are going to follow the silent assumption. That is, we will avoid all variable costs as well as direct fixed costs. 50,000 pesos plus 45,000 pesos, we would have 95,000 pesos. These are the costs that can be avoided if ever we drop product T. Note that we presume that common costs allocated will not be avoided if we're going to make such a drop. Why is this assumption made? Well, this is actually reasonable. When we say common costs, these are usually the costs that are necessary to run the company as a whole, whether we are offering only product T or product S, or both. As such, the most reasonable assumption to make is that when we are going to drop product T, it will not have an impact on this common costs allocated. Just imagine the salary of a company's president. Let us say that the company downsized, drop a department. Will the salary of the president be expected to decrease as well? This is not such the case. Next, we are going to look at the impact of such a drop on the remaining product, that is product S. We have no impact, considering we didn't state whether product T is in any way a complement or substitute of product S. At the end of the day, we are going to notice that by dropping product T, the profits will go down by 55,000 pesos. Since this is a drop in profits, it is advisable to keep product T instead. As you have seen, it doesn't mean that when the income statement of a segment, a product line or a division shows a loss, dropping it will increase your profit. It doesn't work that way all the time. Second question. Assuming S and T are substitutes, dropping product T would increase S sales by 80%. Should U Corp discontinue offering product T? Again, if we're going to keep product T, nothing new will happen. If we're going to drop product T, our sales revenue will decrease by 150,000 pesos, which is the sales revenue generated by product T. Again, the costs that can be avoided would include the variable cost of 50,000 and the direct cost of 45,000 pesos, a total of 95,000 pesos. This time, S and T are substitutes. So, when they are substitutes, one can be used in lieu of the other. Meaning that if we're going to drop product T, some of the customers will go to product S instead. In this case, the sales of product S would grow by, accordingly, 80%. If sales will grow by 80%, naturally, variable costs, by definition, should also grow by 80%. So what will grow in total would be the contribution margin. That is, sales minus variable costs. You would have here the contribution margin of S, 80,000. This will grow by 80%. You would have a 64,000 increase in margins. In this scenario, there would be an increase in profit by 9,000 pesos by dropping product T. As such, financially speaking, it would be advisable to drop product T. Let us go to the third question. Assuming this time, S and T are complements, dropping product T would decrease S sales by 20%. Furthermore, 30,000 pesos of common costs are avoidable should U Corp discontinue offering product T. Again, if we're going to keep product T, nothing new will happen. Zero change in profit. Zero change in profit. If we are going to drop product T, the sales revenue will go down by 150,000 pesos. As for the avoidable costs, on top of the variable costs and direct fixed costs, in this scenario, 30,000 pesos of the common costs are now avoidable, bringing the total avoidable cost to 125,000 pesos. The impact on S would be, again, since S sales will decrease by 20%, both sales revenue and variable costs would go down, hence contribution margin. 80,000 pesos times 20%, we would have a decrease in margins of S, 16,000 pesos. At the end of the day, profits will go down by 41,000 pesos. As such, financially speaking, it would be very advisable to keep product T instead. In this lecture, we had applied relevant costing to decisions involving whether to keep or drop a product line or a division. In the next lecture, we are going to talk about how to prioritize the use of resources that are constrained. Till then, like, share, and subscribe.